All right, welcome boys and girls. Doc Severson here with you. Trade School today, here, Friday, the 13th of September in 2019. So welcome aboard for those of you that are watching live. And for most of you, I'd like to also welcome you aboard if you're watching this on a replay. Could be sometime later today or could be even a year from now that you're watching this content. And I hope that we're creating it in a manner that you can keep coming back to it again and again. And it's timeless creation of content, because really market principles don't ever really age all that much. So we've got some interesting things to talk about today. Let's get into the actual presentation here. So I'm going to say goodbye for a second and get over to the PowerPoint deck here. Today's topic is, I've got a bunch of stuff stacked up here. The trader progression, which you may or may not have heard about before. I might have or might not have referred to this. This is one of my favorites because people love this thing, man. Then by request, I'm going to talk about using the Greeks. And again, by request, I'm going to talk about managing short put positions. So without further ado, let's get right into it here. If you are live and if you can hear me, let me know that everything is working. I will assume that everything is working. Otherwise, never quite sure when you're doing these live streams if, if you're talking into an echo chamber or nothing's working or whatever. So, okay. The trader progression. There is a very natural progression that traders make as they progress from newbies into master traders. I find that this progression, as described by Bo Yoder, is very accurate. So I ran into this gentleman, I want to say sometime about 10 years ago. And he's an educator that focuses on the Forex markets. And I asked him for permission if I were able to use this, and he said, sure, go ahead. So, and it was written some time ago, so you'll see very male-dominated verbiage. This is because women are probably much better traders and don't require as much coaching. So if you see a lot of male pronouns in here, don't be offended. Just apply them towards your own situation. So stage one is mystification. This is where everybody starts. This trader has little or no understanding of market structure. Just stuff happens, right? He has no concept of the interrelationship amongst markets, much less between markets and the economy. Price charts are a meaningless mishmash of colored lines and squiggles that look more like a painting from the Museum of Modern Art than anything that contains information. Anyone who can make even a guess about price direction based on this tangle must be using black magic or voodoo. Now, surprisingly, what I find is that people in stage one tend to do quite well out of the gate, because usually they're finding out about markets for the first time and they are unconsciously just getting involved. Usually they're getting involved in a big trend and they're playing along with what everybody else is doing. And it's usually the very top of the market for that time. This is how people get involved with markets, because they hear other people talking about it, and so they jump on board and magically they seem to do well. And markets can be very simple to them at this point. Buy low, sell high. I think everybody's gone through something like this until it no longer works, right? And this is where we get into the stage of like, uh-oh, maybe I don't know what I thought I knew about markets. But everybody starts stage one, mystification. Now we get to stage two, and you guys should start to recognize some of stage two and beyond. You scan the markets every day, and after a while you notice a particular, let's say it's got a signal which pops up regularly. Maybe it's an oscillator crossover, something like that. And you find more and more instances of it, and you look backwards and you say, man, every time that this thing happened in the past, it worked. And so finally, you get the guts to take a trade, and then your stop is hit. And you're like, oh, Great. So you back off, you study the pattern further, you look for more instances of it, maybe you add another study to it or something like that. Next time it appears, it works, it works, it works, it works, but you're still sitting on the sideline. So finally you gather the guts to take the trade again, and of course you're stopped out. Everyone goes through this. Think of the hot pot stage, right? There's a hot pot on the stove, and every time you touch your fingers to it, you get burned. So where I think people get into this, and Bo Yoder's certainly got his own theories behind this, right? His theory is that, look, there are losses in trading. And I do believe that. There are losses. You can't predict the future. So what you're doing is you're looking for a high probability setup. You take it, and it's either going to work or it's not going to work. However, I think there's one more dimension to that. I primarily see people get stuck in this cycle because they're trading scared money and they're waiting for things to feel good. They're waiting for everything to line up and feel good because they really don't want to take the risk. And perhaps they're using more capital than they should. And as I've said many, many times before, the best trades that you take are the ones that feel the worst. Conversely, the ones that usually don't work out very well are the ones that feel the best because you're going along with everybody else. You're getting that sort of collateral encouragement from everybody else in the market that's saying, yeah, I think it's a good idea for you to go long right now. So waiting for things to feel good is usually a bad thing. So that's the hot pot stage. Again, you identify a pattern. Every time you take it, you get stopped out. What the hell's going on, right? So you figure, well, maybe what I need to do is apply a little bit more knowledge, or maybe even you go to the dark side and go into stage 3, which I see quite a lot of people in stage 3. This is cynical skepticism. You've studied so hard, and every time you take a damn trade, you get stopped out. There must be some kind of evil force that's out there that's preventing you from success. So you read all around the internet, you read all through Twitter, and you look for these conspiracy theories. So Bo Yoder calls this an excuse-driven blame game. And it's a dead-end viewpoint. It explains a lot of what you find on message boards. Those who can't pull themselves out of it will quit because you figured that the deck is stacked against you, that you have no chance. And so you're either going to blame people with more money than you, you're going to blame whales, you're going to blame institutions, you're going to blame market makers, you're going to blame some evil man behind the curtain pulling the sticks behind this. And again, you see a lot of this going on out there in the internets. You see a lot of people blaming others. And quite honestly, I really don't care about this. I've gone beyond this point where every market is manipulated, and you just have to find ways to work around that. If it wasn't manipulated, it wouldn't move. So that's stage 3, cynical skepticism. Now we get to stage 4, and a lot of people get stuck in stage 4. This is where we get into the analysis paralysis phase of trading. So you've gone through the 3 previous stages to this point. You started off, you had no clue what you were doing. And then you started to study patterns in markets, and you identify a pattern, but every time you take it, you get hit. All right, and you get to the point where you get mad and you get into the cynical stage and you figure that there's somebody out there preventing your success. And the logical conclusion to that is usually, well, all I need to do is that I need to add more techniques. And this is where I see people go overboard. You know, maybe the price will be up here on their chart and they've got study 1, study 2, study 3, study 4, study 5, study 6. They've compressed everything in the price to a little tiny piece of real estate up here because they're convinced that these studies down here, trailing studies, are the key. This is the Holy Grail. And so people go on this Holy Grail hunt looking for things. And so they'll listen to somebody talking on the internet and, you know, quite convincingly talking about one specific study or technique. And so they'll buy that and they'll take a couple of trades in here, and usually those won't work out. And so you go through the cynical skepticism phase again and say, well, it must be the problem of the system, or it must be the problem of the guru. And so all of a sudden over here, this bright shiny penny starts attracting you over here on the internet. There's somebody talking about ways to get rich quick. And so you buy into this, you take a couple of trades, and that doesn't work either. And so this is what I see from so many people. They run around and generate this little pile of knowledge over here based on some other system, which is supposedly risk-free, and they find out that there is no such animal. And a lot of times they just run around from study to study to study, and they just go in this big circle again and again, adding more techniques, adding more baggage to their psyche, because they can't get any kind of consistent winning going. Again, this is what I see a lot of folks do. And these are a lot of people that were very smart in their career, and they were rewarded by going deeper in their career. And what you find is that in trading, if you go too deep in too many things, you end up being a jack of all trades, a master of none. And this is characteristic of scared money. You're not accepting the risk, you're not accepting the loss, you're looking for things to feel good, you're looking for ways to get around, you're looking for everything to show up perfectly, right? And a lot of people get stuck in this area and they really never get out. They think that the key to this is one more study, one more technique, one more small pool of knowledge, one more holy grail technique that nobody else knows about. And it's just not like that. So here's the break. This is where things change if you're able to make it through this, which is stage 5. This is where we call this inwardly bound. And you may recognize this if you remember me talking about find your one thing. Find your one thing. This is where you become inwardly bound. So you use all the time up to this point productively. You've learned a lot of studies, you've learned a lot of techniques. And at this point, you have to almost sweep the table off and say, wait a minute, which of these makes sense to me? Which of these really resonates with me? What can I trust? What can I trust myself to do? How many times have you done something where intuitively you just back out of a trade and you can't explain it afterwards? And that's because that's your subconscious mind. You haven't convinced your subconscious mind that you own this yet. You haven't convinced your subconscious mind that your trading doesn't represent a threat to you. You can't joke around with your subconscious mind. You can't fool it. So people in stage 5, what they do is they take the time to go through and really treat this like a process. Really treat this like, if you've seen me do any of the courses before, we have what's called the strategy development cycle, where it goes into big circle, where you start off with rules, right, or goals. You start off with goals in your business plan. You set those up through rules. You get some kind of results, and then you make adjustments, and then you go back again. And the whole idea here is to keep spinning this thing higher and higher and higher. And you have to make changes along the way. This is where you become inwardly bound. And this is where you start taking the trades that don't feel well, because you've learned that those are the ones that worked. And only through time and repetition are you going to find that out. So what you do is you audition all of these strategies. You make sure that they fit into you instead of banging a square peg into a round hole and force-fitting everything. You become scientific about things. You become more interested in how you react to things versus the market. You realize the truth that you are really trading versus yourself, and you're not really trading versus the market. It's just a collection of red and green candles out there. How you interpret that as risk or anxiousness or stress is totally up to you. You accept full responsibility for your trades. You realize that it's you and it's not the market. Nobody's putting a gun to your head and forcing you to trade. You're only trading because you think that there's some possibility of payoff from that. And so you spend the time to really understand what works. And you stop blaming other people about this, right? You stop blaming the broker or the specialist, the market maker, or the guru, or all these other people that are supposedly enemies, the whales, right? You don't succumb to hope, fear, greed, impulsive emotional trades are gone. Instead, you just trade. This is stage 5, inwardly bound. Stage 5, inwardly bound. And then finally, we get to mastery. And I'm not going to go much into this because it's almost like a Zen state. It's almost one of these things where you can't explain what it is that you need to do. You just do it. In fact, words almost fail you trying to explain the setups that you're looking for. Most people that are in stage 6 in mastery have very, very crude systems. They don't need a whole lot of studies. They don't need a whole lot of chart package. They look for very certain things, and they're either there or they're not. And in some ways, it's almost difficult to explain what they're looking for. You might say every business has got this level. I mean, somebody that's a 6-degree black belt can't really explain what body language their opponent displays that allows them to anticipate the move that's about to happen. You could go through just about any kind of venture with something like this unconscious competence where you can't even explain, where your mind is working faster than your ability to really describe what's going on. Okay, so again, stage 6 mastery, this is where everybody gets to, and if you have to ask what this is, you're not there yet, right? And performance has nothing to do with self-worth. A lot of us get down on ourselves, we take a loss, and we go, oh, you stupid idiot. You know, none of that happens here in mastery. Mastery is you're just one with the markets. You understand what the market wants, and it's your job to give it to it. Now, where were you? Did you recognize some or perhaps all of the stages? Most people are in stage 2, 3, or 4. Practically everybody that I give this presentation to insists that they're in stage 5. But usually the truth is something much, much lower than that. Here's the other thing too, is a lot of people that, you know, if you're honest with yourself, a lot of you are, you know, maybe somewhere down here, stage 2, stage 3, something like this. I've never seen anybody skip a stage. I've never seen anybody go from, you know, stage 1 here, and I'll say, hey, I'm just going to skip all that crap and I'm going to go up here to stage 4 and I'm going to start learning here. Well, no, what happens is you tumble back down to here. Each one of these is sort of a platform with which you propel yourself to the next level. It's almost like a state of awareness that you have to convince yourself. I mean, if I were to give this presentation to somebody that's down here that has no knowledge of markets, there is no possible way that they could go straight up to even inwardly bound. They have to earn the right to be able to get up to this point. Because my words to them are just going to be meaningless phrases. They're not going to apply anything towards this. They're going to go, yeah, right. As if, dude, I'll go straight up to 5. Thank you very much. Nope, you will tumble all the way back down. I guarantee it. I would love to take the other side of the trade from you. So I've never seen anybody skip a stage, but what I've seen is I've seen people minimize their time in each stage. Now, you guys may have heard of the 7 stages of grief. You know, like if you get some really, really bad news, right? It's, you know, you go through shock, denial, guilt, anger and bargaining, depression, reconstruction, and finally, okay, it is what it is. I can accept this. But you almost have to go through all these stages first before you get to that point. You're not going to go from shock and then say, oh, well, I mean, unless you've just been shot or something like that, you have to accept it. All right, so you can't skip a stage, but you can minimize your time spent on any one of the earlier stages. If you're truly aware of what's going on, or as they say, if you're woke, right, you can say, oh, I get it. Yeah, I'm looking for trades that feel good, and maybe I should stop doing that. And you got to prove it to yourself, but you can minimize. I've seen somebody that really applied themselves and went from probably stage 2 up to stage 6 in about 4 months. I've seen it done before, and it was truly amazing to watch. It was a very unique individual with a very unique skill set that did that. And I don't think anybody else could do that unless they had the same type of skill set as this person. But you have to understand mindset. You have to understand how markets exploit the fears of others. And until you do that, and until you understand how markets exploit the fear of others, not because the market is nasty and mean, it's because people are irrational and they take steps to protect themselves, which usually come at their own peril. And that's the way that markets work. And that is the traded progression. And so again, this is one of the favorite things. I've been doing this since 2011. So this is 8 years now. I've been doing this presentation. And it was always part of the early part of a course that I would do. Like these, huge blockbuster courses, like, take somebody from 0 to 100 in options trading. I would always start out with the traded progression as the very first thing, so that people could kind of frame it in as a context of like, hey dude, here's where you have to be. I don't care how much passion you have for this. These are the steps that you're going to have to go through before you're going to earn the right to be inwardly bound and or into mastery. Okay, so if you have any questions about this, do yourself a favor here and write them down, or just jot down some questions, because I'll circle back and take questions at the end of this presentation today. But that is the traded progression. So hopefully that made some sense to you and resonated with you just a little bit. So now let's get into the techie stuff here. And I did have a request came through a day or two ago about using the Greeks with options. Can't use the Greeks with anything but options. Coffee break. Okay, option prices move in a very multi-dimensional manner with price, time, and volatility changes. Remember the image that I gave you guys during the options course, where it's almost like you're a puppeteer, right? You've got that little stick with a cross on it, and you've got all the strings coming off of there, and you're pulling on different strings to affect the puppet's hands and feet and maybe mouth or whatever it is. It almost feels like that when you're maintaining an option position, because you get a moving target. It's not like it is with spot currency or even futures, where it's like you're just dealing in 2 dimensions, price is going up or down and time is advancing. And that's all there is to it, right? It's a very linear world in the spot currency world. The price is either going up or down and time is always advancing. It's never going back. Wouldn't that be fun? Go back in time, redo that trade. So with options, you got all these things moving at once, and it can be very confusing to you at first. You're like, what the hell is going on? Why did the position that was in green yesterday and now it's in the red? And what happened? So you need a different instrument panel to determine dynamic changes in the position's value depending on what's happening with price, time, and volatility. Right? So if you're flying, let's go through the 6-pack here. If you're flying, you want to know how fast you're going. You want to know where your wings are. You want to know whether your altimeter is going up or down, and you can see that through here's the first derivative of your altimeter, which is your vertical speed indicator. So you can tell whether or not your speed or your altitude is going up or it's incrementing to the downside. Now, some people might say, well, can't you just watch the altimeter? Yeah, but now you can determine how fast it's going. You can also determine your direction, and here's your compass heading, and that's VOR and stuff like that. So engine speed, and we can go through flying lessons here in a minute, but this is an instrument panel that, flying is very much like trading options, because you've got so many things happening at once, and I can vouch for that, where it's almost information overload. when you're a new pilot. There's just so many things happening at the same time, and managing an option position can be like that. Now, the saving grace here with options is that the way that we trade them, which is usually, a few weeks out, things happen very slowly. It's not like things are just, crazy. We'll get to that point in a minute here, and I'll show you when to avoid the crazy time. So Delta is the first Greek that you need to be familiar with. First and most primary Greek that you should care about. But we'll cover today Delta, Gamma, Theta, and Vega. And these can give you dynamic readings that we need. So in more traditional markets, so this is Think or Swim, and I pulled this off of the S&P 500 ETF or the spiders. And you can see that, with every option chain out there, and this is pretty much with any broker that does equity options, you can pull up on the chain direct values for Delta, Gamma, Theta, Vega, as well as the bid and ask and everything else that you want. So these are markets that have been trading options since the 70s and doing it with liquidity. Now with crypto markets, the best that we're going to do so far, and maybe this will change by the end of the year, there's other firms that are threatening to get into the space, but the best that we can do right now is to make a checkbox and say add Delta to this. So we can't even see what our Theta or Vega or Gamma is, but we can certainly look at Delta. So we're going to be sort of Delta focused today. So let's go through each Greek, and I don't expect you to get this the first time. This is why there's a rewind and play button on our video today. And we'll dive a little further into Delta. Delta is the measure of the change of an option's value. It's the measure of a change of an option's value with respect to a 1-point move in the price of the underlying instrument. The underlying instrument, if you're trading Bitcoin options, the underlying instrument is Bitcoin spot price. If you're trading Ethereum options, the underlying instrument is the Ethereum spot price. No surprise there. Okay, so a delta of 0.62. If you go to the option chain, in this case, we're looking at Bitcoin for 25 October 2019, and this option's got a 0.62 delta. Now, first of all, notice that it's positive 0.62 because there's no negative sign in front of it. So what that means is that for this option, which is currently 12.31 bid by 12.68 offer, or some midpoint price that's in the middle of that, for the next point move that Bitcoin goes up. So in other words, if it goes from, let's see, when I captured this, it was 10.480.75. If it goes to 10.481.75, then we can tack another 62 cents onto the bid and offer prices. Woohoo! Okay, you might see a problem here. That's for the next point move. 1 point move of Bitcoin does not represent much at all. Now, it means a great deal if you have an asset which is doing something like this, like here's the prices here, like 6 to 7 to 8 to 9 to 10, right? So these are stock prices where it goes 6, 7, 8, 9, 10, 11, 12, 13. 1 point move is pretty significant. Even in the spiders, the S&P 500 ETF, 1 point move is pretty significant. It's not so much on the full SPX or full S&P 500, which is about 3,000 right now. So delta to some degree is, it's a very incremental thing. Very, very incremental. Now we can flip over to the other side. What does a delta of negative 0.53 means? Well, first of all, we're looking at the puts. And what that means is the next point move higher of Bitcoin will erase 53 cents of value from this option, which is 12.51 bid by 13.46 offer. So we would expect that. Puts make money as the price goes down, not as the price goes up. Or we can flip this around and say for the next point move down for Bitcoin, it's going to increase this option's value by 53 cents. So this is what delta means. Long calls have long or positive delta. Long puts have short or negative delta. We can also flip this around. If you sell a call option to open, that's a bearish trade, and it will have short or negative delta. If you sell a put option to open, like what we're doing in the course, short puts have a long or positive delta. I know that's confusing. This is what the rewind button is for. Or watch this. Repetition is the mother of skill, guys. So at least we can see the forward value of the next point move. But that's of limited value for something priced as big as Bitcoin is. So where this comes into handy is where you've got, and this is where institutions that own maybe dozens or even hundreds or thousands of BTC will be able to see an aggregate value as the delta number multiplies by the number of contracts that you have. So if you're selling against a certain level, now you'll be able to see an aggregate number because, again, you're going to take the delta, so whatever that delta is, and you're going to multiply it by the position size. And that's your aggregate delta. So that is your portfolio delta. We'll just call this PD, portfolio delta. So now you can see where it really starts to make a difference because now you can say, and this is how we would trade in the prop firm that I was in, is we were not allowed to maintain any larger than a 500 delta. Either plus 500 and negative 500. As soon as we got over that, there was a warning bell that went off and we got somebody in our face saying, what are you doing? You're taking too much risk. So managing your overall portfolio by the risk of the next point move shows you what your risk is of your portfolio. So for example, with 10 contracts, the next point move higher would increase your portfolio value by $6.20 instead of 62 cents for that one call option. So your aggregate portfolio delta is something that funds and investors watch at all times, just like I was talking about, so they know the delta risk of the next point move. And now we get into gamma. And we'll certainly take questions for this at the end of today's presentation. Gamma is the measure of the change. It's the first derivative of delta. So what will my delta be if it does move another point? It's the measure of the change of an option delta value with respect to a 1 point move in the price of the underlying instrument. So if Bitcoin moves another point, what is that option's delta going to be? Can you see how that might be important to know from a risk perspective? Delta is not linear. You can't just say, well, 1,000 points from now, that'll mean delta will be, you can't extrapolate it like that because it shifts and it changes. The value of delta changes depending on the proximity to the actual price. So gamma shows the speed of change of delta. Remember when we looked at the cockpit, when we looked at those instruments on the cockpit, we could look at the altimeter, right? The altimeter is very important. We need to know how much airspace we have underneath us. But the instrument right below it was the vertical speed indicator. It shows us how fast we're moving up or moving down, and not just the absolute level of altitude. So that's kind of what this does here. This is what gamma is for. It can be a little confusing until you start to use it and see how it applies towards yourself. And what's cool is here, it allows you to predict what your delta risk will be if the underlying price moves X number of points either towards or away from a position. So in other words, if it moved another point, what would it be? It allows you to be proactive instead of reactive and moving your arms all over the place and saying, whoa, the sky is falling. You can be a more proactive risk manager. It's less useful with one contract on BTC where 1 point move is not really meaningful. The other thing that happens too, and this is Gamma tends to be more effective right at the money. So if this is at the money means where the current price is. So we'll see this come more into play. So what this means is if we're way out, if we have an option that's way out of the money, 1 point move is not really going to make much of a difference in the delta of that option. In fact, it won't move at all if it's way out of the money or even way in the money. But when you start getting right at the money, this is where the magic occurs. This is where you start getting more of effect of gamma. And here's the crazy thing. When you get right near expiration, so if we're talking about options that are expiring today, this is where you have the effect go something like this. It makes a huge difference to the delta of that option, depending on how close it is to the money. Now, why do you need to know that? Why do you care about that? This is another reason why you should not try to manage live positions at the money near expiration. Try to be out of them at least a week prior to that. What you'll see because of that huge gamma spike right around the money means that your P&L of the position will vary dramatically if the price moves just a little bit. And so here you are, you're trying to nurse this thing into profitability. You're hoping for just one more little move, and that's either going to work against you in a magnificent way, or it's going to hurt you really bad. And you'll see wild swings in profitability. So do yourself a favor, don't go through that. Now, just because of the fact that I'm saying this, eventually some of you will have to go through this just to prove it to yourself. But this is not what you want to be doing. You don't want to be playing that hero routine right around expiration. Let's get to the easy one. Theta is probably the simplest Greek. It's the measure of the change in an options value with respect to a one-day change in time. First of all, we're not talking about the actual price anymore. We're talking about the change in an options value. We don't care about the underlying price. So time ticks away, and how much more or less will this position be worth in 24 hours? Long options will going to have a short theta value. Short theta means if you buy an option, that's an ice cube that's melting every single day. And how much it melts is your theta value. Short options will have long theta, because that option is still going to melt, but because of the fact that you sold it to open, you want it to melt. You want it to disappear. You want to be able to buy it back for a lot less than you sold it for. This works in your favor. So look at this. Here's the difference. Here's an option with 10 days left, and it's going to, over the course of the next 24 hours, it's going to reduce in 7 cents of value. So we're going to go from $1.17, and actually the way that you read this, because equity options are weird, because this is a per share basis. So if you multiply it by 100 shares, we're talking about an option here which is $117 bid versus $120 ask. And so we're talking about this option is going to, over the next 24 hours, is going to bleed $7 of value. So 7 out of 119 or something like that, maybe 5 to 6%. That's pretty significant. So just in 24 hours, this option is going to bleed, say, 5 to 6% of its value. But that's because there's only 10 days left. Time is ticking. Now, if we go out to some option with a lot of time left, so we'll go out to next year, June of next year, 280 days. And this option right now is worth about $1,600. It's worth about $1,600. And it's only going to drop $3 of that. That's not even a percent. It's, point something percent. So there's very, very little time bleed on an option. So we've drawn this before. We talked about the value of an option with time, and then this is where it goes down very quickly as there's little time left. So this one's in this section up here where it just very little is going on. So that's theta. Portfolio theta value is also an aggregation of all the theta values multiplied by position size. So what's cool is if you have a bigger portfolio, you can look at your monitor screen for your option broker and you can say, okay, my portfolio, I've sold a bunch of premium and maybe I have some of it long. You can say that, look, my portfolio is making me, X number of dollars per day just in the time value bleed that it's got, which is cool. It's cool to look at something like that. Now we'll get into Vega. And if any of you are old enough to understand this reference and understand how terrible this car was, then you're as old as I am. Okay, so Vega is the measure of the change of an option's value with respect to a 1% change in volatility. So no longer are we talking about their underlying price. We're not talking about time. We're talking about implied volatility changes. So implied volatility changes, think of the implied volatility on an option as, just like a balloon. Just a little balloon, and it's going to go out with more implied volatility, or it's going to contract with less implied volatility. Just think about it like almost like breathing. And when things get scary, this is when this will expand out to a huge value. And that affects the time value of that option. Not the intrinsic, but also just the time value or the premium of it. Okay, so Vega shows the measure of the change of an option's value with respect to a 1% change in volatility. So again, it's based on implied volatility, not historical volatility. So right now the problem with crypto is there's not really any sources that show you what the implied volatility is to track it. I mean, you can look at the Deribit chain and you can see what today's implied volatility is. But there's no charts to track it, so you don't know if it's relatively high or low unless you're going to track that sort of stuff. So long options gain value if volatility rises. If volatility rises, it shows that the implied forward move is bigger. And so it's going to price that in. It's kind of like looking at the future is what the market sees about the future, right? And short options that you sell to open are short volatility. They want volatility to contract. They want the price to do nothing. So when you sell a position, short options, you're going to be a short vol trader. So this is why you want to be looking for those pullbacks to enter, because that's where volatility will spike up. And then with any structure beyond the chart that you're trading, that will revert back to the mean. The implied volatility will come back down. And because of the fact that you sold a short vol, you established a short volatility position, it will also go up in value, not only because of the delta, but also because of the volatility. This is where you get this explosion of profitability on a position. So some advice with the Greeks. We've just gone through the 4 Greeks now. Don't try to learn them all at once. It's really tough. I mean, it can be done, but what I would focus is just one at a time. And right now, delta is going to be your most important one. So I would say delta, understand how delta, just even if you understand, look, it's a long delta position. Long delta means bullish, wants to go higher. It'll gain value as the price goes higher. And then you'll see a need to understand, and as the tools get better and better in crypto, you'll see those applied to the option chain. And then that will give you, I wouldn't say an edge in terms of entering a trade, but what it will do is give you an edge in terms of your risk management. And if anything, that's the one big difference between amateurs and professionals, is their ability to risk manage a position. Amateurs have no risk management, So therefore, they can win 9 trades out of 10, and then the 10th trade blows them out. Where that will not happen with a pro. Now we get to the final section here, which is managing short puts. So this is fairly short, and this is just kind of an appendage to the course that we just produced last month. So the first thing to do before you open the position, this is rule number 1 of risk management, is to determine a stop for the position. So what I mean by this is to say, okay, so the price is maybe doing something like this, throwing off some pivots, throwing off some support levels, and you see a pullback and you want to sell against a put. And you're going to, or you want to sell against a price level with a put. So you're going to identify these price levels down here, and you're going to say to yourself, okay, where am I going to sell this position? Maybe it's going to be down here. And I'm okay with the price. Maybe, you know, you're going to make a decision as to whether or not you're okay with the price coming all the way down to here, or maybe even undercutting that. Maybe an undercut of that would force you to an exit. To say, well, it's no longer the support level that I thought it was going to be. I no longer want the position. You got to determine that before you open the position. You can't do that on the fly, because you will make the wrong decision. You will do the wrong thing at the wrong time. That's the way the human brain is wired. So that's going to depend on somewhat where your goals are, if you're going to be, and also it's going to depend on your broker as well too, because some brokers conduct physical settlement, some do cash settlement. So LedgerX physically settles the contract in BTC. So if your goal is to pile on more BTC, you may not care about that. You may say, well, I wanted to buy more and I bought it at a discount, but even though the price went a little bit lower than that, I'm still doing okay because I got paid for that pullback. You got a credit for that pullback. So if the put option expires, you keep the BTC credit. If the put option expires in the money, then you're assigned BTC that you're obligated to. So not only did you get the BTC credit, but you also got, you know, magic. Here you go. Here's your BTC that you signed up for. But Deribit cash settles it. So an in-the-money settlement, they're going to take BTC away from you, which is not what you wanted to do. So Deribit is more for just trading and stacking sats through trading versus being awarded or assigned BTC, if that makes sense. So it depends on what exchange you trade on as to whether or not you allow the position to expire in the money and settle. So in other words, if you're trading something like LedgerX, the price is doing this kind of thing, so you sell on a pullback and maybe you sell at this level here. So let's say that the price does something like this. Now you're obligated to buy it there. You're obligated to pay that for it. So they will take the funds out of your account and charge you for that price of it. And it may be lower by the time that you get assigned that. But don't forget that you also did receive a positive credit for that. So that will drop your cost basis to some degree. But the point of using LedgerX or any type of physical settlement is if you want to accumulate and keep stacking on Bitcoin. Otherwise, if you're using something like Deribit, so Deribit, let's do the same example here with something like Deribit. So maybe you're going to sell at this level with Deribit. All right, the price comes down to here and starts to go down under that, and you might say, well, okay, now I'm in a loss condition. I don't want to do this, so maybe what I'll do is I will close down the position. I'll close this down, and then I'll move this out further in time and further down in distance. Now, I'm exaggerating this move. Usually you can't move it that far, but let's assume that you got more implied volatility here. So you're going to shut this down at probably a loss unless you're doing it at the very last day prior to expiration. And then you're going to move it lower and further out in time. Further out in time, let's say this is the expiration here, here's the expiration here. So this allows you to become a little bit more nimble. You don't have to take the loss through the cash settlement. You can just, you're going to take a loss one way or the other. Plus you don't have to pay the settlement fees. So that's what a roll looks like. And this would be, again, this would be ledger X is, you know, physical assignment, and this is going to be debit. The market character will also play a role in determining your exit. So remember, in the program I talked about, you could, you know, set up something conservative, like maybe 50% of profits is where you're going to take your profit exit. Or you can say, I want to be super aggressive and I want to just let that thing expire to nothing and take the full profits for it. Okay, one is obviously more aggressive than the other. It's going to depend somewhat on what's happening in the market. If you've got a market doing this kind of thing and just pulling back and then going super hard, pulling back and going super hard, then maybe what you want to do is sell against that level. Sell against that level and just let it go. I mean, if you're lucky enough to get a trend that's that strong, you know, quite honestly, what you want to do is you want to be long something, but if you're using this to augment your income or perhaps get a better entry on it, just let it go. But if you've got a market that's doing something like this, hint, hint, like now, just chunk it, chunk it, chunk it, chunk it, chunk it, like that, then if you're going to sell on a pullback, you might want to be taking profits up here. Sell on a pullback, take profits, whatever they are. Sell on a pullback, take profits. Because you don't know if this is going to head down to a lower low. So you want to sell into weakness and buy the position back on strength. Precisely what your brain does not want you to do. Okay, let's see if there's anything else here. So while a choppy market would be better for taking profits that are available, entered right after your initial fill. Okay, so that's that. And we're going to get into questions. So that is the material I had for today's trade school. And Tig has teed me up one here. Doc, if your price hits your mental stop, do you exit immediately or do you wait for a close of the candle? That depends on how you want to run things. There's really no right answer to that. So the question here is, do you wait for the close of the candle or do you just, you know, let's say if you have a position down here and if it's getting run through, do you wait for the close of the candle? So the risk and reward of that, let's take the two positions. So if you just exit right here, the benefit to that is you have a known exit and you've saved yourself if the price does this. The drawback to that is if the price does something like this by the end of the day. And you don't know the answer to that. You don't know what's going to happen with that. Now, some people would prefer to do an exit based on the close. And so again, you're either exiting down here or you could be exiting or just staying in the position if it goes up here. Again, you don't know. And I think everybody needs to make that determination for themselves and stick to it, because typically what will happen is the people that, here's what I see happen, is the people that take the instantaneous exit and then see the price do this, the next time they're like, oh man, all right, next time I'm going to do the daily close. And then what happens to them is, you guessed it, it closes down here. And so they're, you know, super unhappy down here. And this is where they get into cynical skepticism and think that the market's against them. What you have to do is to pick one way that fits with your criteria, that kind of resonates with how you think the market structure is, and just stick to it. And don't get wigged out if you get faked out. Don't get wigged out if, because you just can't tell. So because of the fact that I do this all day long and I don't work at another job, I'm more of the mode of like, hey, if something happens since I'm here, I'll just take care of it and get out of it right now. But for people that work, typically a daily close is going to be something that they're almost forced into using. Right? So it depends on your situation. It depends on your sense of risk and reward. It depends on where you work for a job. And the other thing too with something like this is this can also depend on crypto, right? Because crypto can be odd. You can be sleeping and all of a sudden your mental stop is hit. And as we know, we're not going to be putting a stop into an option position. We're not going to put a good till cancel stop limit in there. Ooh, bad idea. Bad idea. You will get stopped out of a good trade. So there may be conditions where it's just, I'm sleeping and the price just goes right through it. And I just have to live with that. So it's going to depend a lot on your conditions. Are you going to set up alerts and stick a phone under your pillow and get woken up every time that there's a price alert? No, thank you. I'm not going to do that. Okay, any other questions for today? We're coming up on an hour for our session here today. So that's, think about that for a minute. So let's replay for a minute. We talked about the trader progression. Where are you in the progression? Let me know if you have any questions about that. We also talked about Greeks, which I'm sure for a lot of you, you're like, ooh, boy, how do I apply something like that? That will come in time. There's no instantaneous benefit for you unless you're running bigger positions that you can put a delta value to your portfolio and then start doing delta hedging, or knowing, certain criteria that you want to manage your portfolio by. So really it's kind of a big boy game right now, managing a position by the Greeks, doing portfolio management, just because of the way that delta is calculated, because of the fact that Bitcoin is such a huge number and is only going to get worse if it goes up to 100,000. That's a good problem to have. So Greeks is something, but if you do transition this over into traditional markets, which is something that I hope you guys are going to do, whether it's a natively equity market, or it could even be commodities. You can use the same principles for that, because this is where they came from in the first place 40 years ago. So it's not like crypto is educating everybody else, it's the other way around. So you can use these same techniques in traditional markets. And then lastly, we talked about managing a short put position. Again, a lot of that is going to depend on what you're using, what your goals are for the position, and how you intend to do it. All right, boys and girls, we have come to the end of Trade School here for today. So I want to thank you guys for hanging out with me. And please let me know if there's anything else you'd like to see on any of these weeks. I always like to do these things based on what you guys want to see, and not something that I've got a bone to pick with, right? So it's always better if these are centered around what people are asking for. So thanks, everybody. We'll see you soon. You guys have a great weekend. Take care now.